Hey everybody, Allison here, and in today's video I am going to talk about how you might consider playing Google's for earnings. But keep in mind that these strategies that I talk about you could technically apply to any earnings this week or in the future. So there are two different ways that I personally like to play earnings. I either look to play the theta decay, meaning I think it's going to stay in consolidation, and so I look for that suck out of premium after the earnings announcement and have theta work in my favor. Or I play it with the anticipation we might get a bigger than anticipated move, right? A gap move either up or down, and look to play more off the volatility. So with Google, I'll go over both trade ideas. As of right now, given how the chart looks, I would lean more towards playing off of the potential gap move that could occur. But at the same time, we certainly know how the market likes to be equal opportunity dream killers. And so it certainly wouldn't be out of the question for it to be a non-event and kind of hang out here, which is why I'll also discuss a potential iron fly strategy. But the first one is, like I said, the one I'd probably play for more, which is the anticipation of a volatile move to the upside. Now, there are a few different ways to, of course, consider going about this. And the way that I have liked to do a lot this year is by incorporating broken wing debit butterflies. And in this case, one on the call side and one on the put side. The idea behind this trade is that if we gap up or gap down, I ideally will look to still make an overall profit. And by having it be a debit broken wing butterfly, it gives me the flexibility of having the underlying price be a really big move, maybe one bigger than I wasn't anticipating, and having the strikes go completely in the money and still give me a profit potential. So let's talk about that. Right now for the strikes that I'm looking at here, it's the 106, 111, 113, basically a 5-2 width spread. 5 points on the debit, 2 points on the credit. The reason why I'm looking at this is because the anticipated range right now for this week, including the earnings announcement, is around $6. So roughly a 6-point move higher would be around 108.50, which is encompassed by this fly. So that sets us up well. The other reason, though, why I chose these strikes is because the ATR trailing stop is at 106.71. So that too would be incorporated with this if all we did was move up to test resistance and stall. The call side should be profitable. If we break the ATR and go towards the 100, that's around 110, 109, 110, that would put us closer to the short strike here. So I like the setup, and I certainly like the cost basis of about $1. The other side of this would need to be on the put side, because remember, I don't know, right? Unless you're an insider, you don't know what's going to necessarily happen around earnings. But even so, you don't know even as an insider technically how the market's going to react to those earnings announcements, right? It could be great earnings, and we've seen the market sell off before on that plenty of times. So I also want to look at doing this on the put side. Once again, the anticipated range would be about 6 points. So I would want to encompass in some way the $96 price level. And in this case, given that we have some support around 99, I don't think it would be too bad to maybe start there. 100 wouldn't be too bad, but I feel like that might be a bit rich. So let's just test it out. Oh, actually, it's not. So 100, 95, 93. 96, of course, is right within that 6-point range, puts us nicely within that price of the butterfly and near our short strike. Of course, we know if the market really, gets a bold move to the downside, it could just keep selling off from that. So that once again helps out with the broken wing factor. The low end of this range, 93, not too far away from the lows of the year at 94.38. So, and of course 100 as a psychological level. So if we just go down to test 100 and stall, ideally we could still look to close this for at least break even, if not a profit. So in total, you can see that both of your trades combined, the call broken wing and the put broken wing, cost about $2, right? 205. And so that's not too bad, because if you get the pin, then it's still going to be about a $3 profit potential. And if you go completely in the money, it will still allow for about $1 profit potential, right? So not a bad risk versus reward. If it goes completely in the money and overshoots one way or the other, you still get about a 50% return on your risk. If you end up getting near the pin on one side or the other, then you have over 100% return on the risk that you can get. And the best thing I like about this strategy is, especially on something like Google, where you're going to have time after the announcement to still potentially trade this, is sometimes what happens on earnings is you get a gap up and then a reversal. We kind of saw something similar happen here, though it had such a strong gap, it didn't reverse as strongly. But that possibility, right, if we just gapped up into resistance and then started to fall back down, gives us potentially the opportunity to take profits on both the call and the put broken wing. Now, when I look to close this out, I definitely want to make sure the side that I close out has enough of a profit where it covers the risk completely on the other side and keeps me net ahead. But that can sometimes be the benefit of this compound butterfly strategy in a volatile market like this, to play both sides of that volatility without necessarily having to be right about the direction. So once again, you could consider that for both, Google earnings. You can consider that for Amazon earnings, Apple, whatever. I usually just take the range and apply it accordingly with that and the chart levels that I see that I think are plausible to reach, if not test. The other way to play this, like I mentioned earlier, was with an iron fly. So if you think that it's going to sit more in consolidation and be a non-event, then you can have this premium work in your favor. And usually for things like iron flies, myself, I'll wait closer into the close before this announcement happens into tomorrow, and then I'll look to place my short strikes near where the underlying price is trading, and then go out the anticipated range on my long strikes. So 6 points out this way would be 96. 6 points out this way would be 108. You can see it's about a 445 credit versus a 155 risk. So the idea, of course, not a bad risk versus reward, and the idea is that we don't really move, that we stay within the 6-point range and kind of chop. And in turn, the premium that's all spiked up in there due to the uncertainty around the announcement and that potential for volatility, once it realizes that it's not moving, right, all that premium gets sucked back out, and so it should allow for a quick win that way. So those are the two different ways I usually consider to play earnings. One's more a directional move based off the idea that you'll gap or get some volatility. The other one is playing off the lack of volatility. So take that into consideration for Google or for any of the other earnings this week if you decide to hold through it. And just keep in mind, anything can happen around those announcements. So please, please, please keep your risk on the smaller side. That way, if it's a win, it's a nice win. But if it's a loss, it doesn't blow out your account in any way. As always, may the trade be with you, my fellow Jedis, and I look forward to talking to y'all next time. Bye, guys. Hey, Allison Ostrander here, Director of Risk Tolerance at Simpler Trading. Thanks for watching the video. If you enjoyed this video, please be sure to like and comment down below to help us out. Also, be sure to subscribe and click the bell icon so you can get notified when we release our next video. And if you want to watch us trade in real time using our own money, go to simplertrading.com to learn how to sign up. As always, may the trade be with you, and we'll see you in the next video. Bye.